Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last lecture, we analyzed the massive mathematical gravity of the Magnificent Nine. But what about the other 491 companies in the S&P 500? They certainly don't move randomly. Today we are going to break down the rest of the market and look at the exact economic engines that drive it. Let's dive into S&P 500 sector composition. The stock market is officially divided into 11 sectors under the Global Industry Classification Standard, or GICS. However, as a quantitative trader, simply memorizing a list of 11 sectors isn't going to help you make money. You need to understand how these sectors behave in response to economic gravity, specifically interest rates and inflation. To do this, we group the 11 official sectors into 4 distinct macroeconomic behavior categories: growth, cyclical, defensive, and hybrid. Let's walk through each one. First, we have the growth or offensive sectors. These are information technology, communication services, and consumer discretionary. These sectors are highly sensitive to interest rates and thrive on economic optimism. Notice anything familiar? The entire Magnificent Nine lives exclusively inside these 3 sectors. When you buy a broad growth ETF, you have heavily buying these exact same mega caps. Second, we have the cyclical sectors: financials, industrials, materials, and energy. This is the physical and financial engine of the real economy. They expand when GDP is growing and manufacturing is booming, but they contract sharply during recessions. Third, we have the defensive sectors: healthcare, consumer staples, and utilities. These are your safe havens. People must buy medicine, grocery, and electricity regardless of whether the economy is crashing. These sectors offer low volatility and steady dividends, acting as a protective anchor during bear markets. Finally, we have our hybrid sector: real estate investment trusts, or REITs, need economic growth to fuel commercial properties like Cyclical, but because they pay massive, legally mandated dividends, they trade almost exactly like bonds. This makes them highly sensitive to interest rates, like defensive. Why must you know these 4 categoricals? Because institutional capital rarely leaves the market completely. Instead, it rotates. When the Federal Reserve starts hiking interest rates, the smart money doesn't just go to cash. Institutions will sell off their high multiple growth stocks and rotate these billions of dollars into defensive and yield-heavy sectors to protect their capital. To track this flow, institutions use the select sector SPDRs, a specific group of ETFs whose tickers all begin with XL, like XLK for tech or XLF for financials. By tracking these ETFs, you can mathematically observe the rotation of capital and align your trades with the macroeconomic tide. By understanding sector behavior, you can anticipate market movements before they happen. Note that we have mentioned ETFs like SPDRs. It's time to fully define them. In our next lecture, we will formally introduce exchange-traded funds, breaking down passive versus active management. See you in the next video.